Bitcoin spent months trading above $100,000, yet many investors walked away from 2025 feeling confused rather than victorious. According to Joe Carlasare, this frustration is not accidental. It is the result of broken expectations, misunderstood inflation, and a Bitcoin market that may be quietly moving into a completely new phase. In a single podcast conversation, Joe laid out a case for why the 4-year Bitcoin cycle may be ending, why inflation around 3% changes everything, and why a new all-time high in 2026 could be far more important than any halving rally. Joe Carlasare recently joined the What Bitcoin Did podcast for a wide-ranging conversation about Bitcoin, macroeconomics, inflation, interest rates, and where markets may be headed next. The episode ran well over an hour and covered everything from Bitcoin price targets and market structure, to Federal Reserve policy, bond market risks, and why 2025 felt so disappointing despite strong headline numbers. This video condenses that entire discussion into a clear, easy-to-follow summary of the most important ideas Joe presented, designed for viewers who want the insights without listening to the full episode. If you find this kind of breakdown useful, consider liking the video and subscribing to our channel. According to Joe, one of the biggest disconnects in 2025 was between headline performance and investor experience. On paper, Bitcoin had a strong year. It began the year in the low $90,000 range. It reached a new all-time high on Inauguration Day around $108,000 to $109,000. Later in the year, it pushed as high as roughly $126,000. Historically, that would be considered an excellent year. But Joe made the case that markets are not judged purely on price levels. They are judged on expectations. Many investors came into 2025 expecting a clean, explosive post-halving rally similar to previous cycles. Instead, Bitcoin spent much of the year moving sideways in wide ranges, with repeated failed breakouts and long periods of stagnation. Joe explained that this type of market environment is psychologically draining. There is no euphoric upside that rewards conviction, and no sharp downside that forces capitulation and clears the market. Instead, investors are left questioning their positioning month after month. According to Joe, this is why sentiment deteriorated so badly, even though Bitcoin never experienced a catastrophic collapse. Earlier in the year, Joe drew attention for a Bitcoin price target that stood out for its restraint: $130,000. At a time when many forecasts were calling for $200,000 or higher, Joe's target appeared conservative. However, he explained that it was based on observed market behavior rather than optimism. Joe made a strong case that $100,000 represented a major psychological level for early Bitcoin holders. For many long-term investors, reaching 6 figures was the point at which they were willing to distribute meaningful portions of their holdings. That supply mattered, especially in a market that was already digesting years of accumulated gains. Joe also referenced proprietary indicators suggesting an upside range in the mid-$130,000 to $140,000 area. But he emphasized that markets rarely reach idealized targets. They tend to front-run expectations and reverse before consensus levels are reached. When Bitcoin peaked near $126,000, Joe viewed it not as a failure, but as confirmation that the market was behaving rationally. Joe highlighted an important event that many investors overlooked. In October, a large liquidation event rippled through the crypto market. Market makers and liquidity providers suffered balance sheet damage, reducing their ability and willingness to provide aggressive bids. This did not result in a dramatic crash. Instead, it quietly altered market structure. Liquidity became thinner. Risk tolerance declined. Upside momentum became harder to sustain. According to Joe, this type of damage does not resolve overnight. It creates an environment where price struggles to trend, even in the absence of overtly negative news. This helps explain why Bitcoin spent so much time feeling heavy and unresponsive, despite strong long-term fundamentals. When it comes to inflation, Joe offered a more nuanced framework than the dominant narratives. He emphasized the importance of distinguishing between absolute price levels and the current rate of inflation. While prices are undeniably higher than they were several years ago, the rate at which prices are increasing has slowed significantly. Joe views inflation in the 3% range, roughly 3.1 to 3.2% CPI, as sustainable. Not ideal, but far from catastrophic. He argued that inflation only becomes systemically dangerous when shelter costs rise to the point that homeowners are forced to sell in large numbers. According to Joe, current data does not support that scenario. Short-term rental owners are largely breaking even rather than collapsing. Institutional real estate investors are absorbing losses rather than engaging in forced liquidations. As a result, Joe expects housing prices to stagnate rather than crash, slowly declining in real terms over time. Joe made it clear that he does not view recession as the primary threat facing markets. Instead, he focused on confidence in monetary policy. The effective federal funds rate currently sits around 3.65%. Inflation remains near 3%. That leaves real rates close to zero, and potentially negative if rates are cut further. Joe warned that sustained negative real rates could undermine confidence in the Federal Reserve, particularly if rate cuts appear politically motivated rather than data-driven. He pointed specifically to the bond market as the pressure point. A sustained move in the 10-year Treasury yield above 5% would signal serious stress and could force widespread portfolio rebalancing. In that scenario, equities and risk assets would face selling pressure, not because of deteriorating fundamentals, but because of mechanical flows. Bitcoin, increasingly held alongside traditional assets, would not be immune. One of Joe's strongest arguments challenged a deeply embedded belief in Bitcoin markets: the 4-year cycle. Joe argued that Bitcoin's historical sample size is far too small to justify deterministic conclusions. 4 or 5 cycles do not constitute a reliable law of market behavior. More importantly, Bitcoin today operates in a fundamentally different environment. Spot ETFs, derivatives markets, and sophisticated hedging tools have transformed how capital interacts with the asset. Joe pointed out that many of Bitcoin's supposed rules have already been broken. Bitcoin has traded below prior all-time highs. It has made new highs before a halving, and it failed to deliver a clean post-halving rally in 2025. According to Joe, insisting that the old cycle model must still apply ignores how much the market has evolved. Joe believes 2026 could be a pivotal year for Bitcoin. If Bitcoin makes a convincing new all-time high above the $126,000 level in 2026, Joe argues that the 4-year cycle narrative would effectively collapse. That collapse would be constructive. It would force investors to stop treating Bitcoin as a short-term trade that must be exited on a schedule, and start viewing it as a long-duration asset influenced by macroeconomic conditions. Joe expects Bitcoin to increasingly resemble mature assets such as commodities, characterized by long consolidations followed by stepwise revaluations higher. This kind of market structure is less exciting in the short term, but far more attractive to institutional capital. Joe was equally direct when discussing Bitcoin treasury companies. He expressed skepticism toward business models that rely primarily on diluting common shareholders to acquire Bitcoin. Over time, constant dilution makes sustained outperformance extremely difficult. Joe expects consolidation, restructurings, and failures within this segment. By 2026, he believes there will likely be fewer Bitcoin treasury companies than there are today. The companies that survive will be those with scale, discipline, and access to non-dilutive capital. Joe's overall outlook can be described as cautiously optimistic. He does not believe the economy is on the verge of collapse. Instead, he sees the potential for economic reacceleration if confidence and policy stability are maintained. For Bitcoin, Joe believes a 2 to 3 times increase over the next 5 years is a realistic base case, which would already represent exceptional performance at Bitcoin scale. He also maintains that much higher long-term valuations, including the possibility of $1 million per Bitcoin, remain achievable through gradual adoption rather than speculative excess. The central takeaway from Joe's conversation is simple. Bitcoin maturing does not look like constant euphoria. It looks like patience, structural change, and the slow rebuilding of confidence. And according to Joe, that process may already be well underway.